This situation, in my opinion, should be a cause for concern to all of us. It is reminiscent of weak banks and stagnating growth witnessed by Japan in the 1990s, with repercussions even to date, and by Italy since 2010. Japan has experienced, and Italy is, in my opinion, experiencing a lost decade.
India's banking sector has been going through a rough patch for the last 5 years. The number of non-performing assets, NPAs, has skyrocketed. At its peak, the gross NPA to advances ratio exceeded 11%. Until the NPA crisis hit, banks contributed more than 90% of the economy's commercial credit. As a result, any impairment of banking has a deep and long-lasting impact on the economy. There are deep institutional issues with these PSBs, which came into being in 1969 as a result of bank nationalization. For the first 25 years, PSBs enjoyed a near monopoly in Indian banking with a share of over 90%. The only other banks were the old private banks that were deemed too small to be nationalized and a few foreign banks. During this period, great homogenization of the PSBs occurred under government ownership. Management structure and human resources policies, including compensation and governance, were standardized. The senior management pool became fungible across the banks. At the end of this process, PSBs operated as one entity with over 25 different names. In 1991, India launched economic liberalization and privatization. As part of the various liberalization initiatives, new bank licenses were issued to private sector players who started operating in the mid-1990s. By the early 2000s, they emerged as credible competitors for the PSBs. As the new private banks began challenging the PSBs, the weaknesses entrenched in PSBs over 3 decades under government control became apparent. They lacked any competitive advantage. The PSBs are also used as instruments of government schemes and programs. This weakens internal governance. In the past few years, the government has driven 2 schemes aggressively, the Jan Dhan Yojana and the Mudra scheme. The first is a liability-side scheme where accounts are opened for unbanked customers with few conditions such as minimum balances. The latter is a lending scheme for micro and small enterprises. While the intent for both these schemes seems noble, scant attention has been paid to their commercial viability. PSBs have been implementing them without any credible business case.
With the increased NPAs which have hit the media, as well as the bribery and corruption issues, that stability has become a question mark. Everybody talks about NPAs in the media. The question becomes, what are these NPAs? How do we unmask them?
Because the public sector banks are the biggest banks in our economy, accounting for about 70% of the assets of the banking system.
As of March 2018, non-performing loans at commercial banks peaked at 10.3 trillion or 11.2% of total advances. The corresponding figures for public sector banks are 8.9 trillion and 14.6%. These ratios have come down slightly since then. As of 2007-08, the ratio was only 2.26%. How did this happen? An analysis will help to identify the areas which need attention and reform. Table 1 provides a set of data which will help our analysis. The rise in NPA ratio, part of the reason lies in the extraordinary credit boom that the country witnessed since 2003-04. Between 2003-04 and 2007-08, the outstanding non-food credit expanded by 3 times. Between 2007-08 and 2011-12, it again doubled. During the next 4 years, it increased by 1.5 times. In absolute figures, the increase in 3 successive periods is 15 trillion, 22 trillion and 26 trillion, and during the 3-year period, 2016-19, by 26 trillion. In addition, the assets under management of mutual funds and credit extended by NBFCs have also expanded enormously. The nominal GDP during these periods increased by 15.08%, 15.56%, 12.05% and 11.3% respectively. It must also be noted that there was considerable tightening of monetary policy between 2004 and 2008. The repo rate was increased from 6% in March 2004 to 9% in August 2008. During this period, the CRR was also raised from 4.75% to 9%. Thus the credit expansion happened despite tightening between 2004 and 2008. However, during 2008, the repo rate and CRR were lowered substantially in response to the global financial crisis. There was a mild reversal of this between 2009 and 2012. There was a reduction in repo rate during 2014-19. This period was marked by a slowdown in real growth.
Think about which banking sectors out of the 07-08 crisis have come out well. It's the US banking sector. Why? Because they took the biggest pain. They took the biggest hit. What did they do? In fact, they took an actual serious bank failure, right? They took Lehman Brothers, Wachovia, Washington Mutual. Why did that work? Because it aligned political thinking with the economic needs of United States banking sector at that point. And it's that alignment which is most important. And I find that gradual recognition of losses doesn't escalate the matter to a point that it needs to be. So I'm not suggesting we should have a full-blown banking crisis.
Right.
I don't think we need that. But I
think booms are generally succeeded by stress in the banking system. This has happened in India also. Credit expansion was phenomenal, with average annual growth rate at 18.69% while nominal GDP growth rates were 12.62%. It is true in a period of economic expansion, every project looks rosy. Exuberance becomes all-embracing, partly rational and partly irrational. It is also seen that there was substantial flow of credit to certain sectors like infrastructure, roads, power, telecom, iron and steel, mining and aviation. While all these sectors are important for growth, these were also subject to severe output fluctuations. Court judgments had an impact on mining, power and steel sectors. Large Chinese imports affected the iron and steel industry. What led to the large expansion of credit? Was it out of free will of bankers or were they nudged by the government? Were they afraid of being labeled as lazy bankers?
To see the cause for the problem faced by the companies also. One of the major causes is downturn in the economy, and the other cause is that the infrastructure projects for which finance has been given have been stuck up because clearances from the environmental clearances and land acquisitions and some such other problems are there by which the projects are not going ahead further. And there is an inability to service the loans which have been taken. Now, when such a situation is arising, banks have no option but to keep the needs of the industry being met from time to time. And it is this hype which is created about so much NPAs and a sudden spurt of levels of NPA going up and all that is going to create a further problem for these industries because there will be a reluctance to lend to these new such accounts on the part of the public sector banks on account of CBI, CBC questioning the second guessing the decisions of the lenders and starting investigations and inquiries into the credit decisions taken by the banks. So this is not only going to particularly in regard to cases which are viable and which can turn around by giving further finance, will be stuck up. And if no finance is given, there will be a problem faced by these such industries, and it will worsen the problem than what it is today.
Private sector banks were as exuberant as public sector banks. Some of the private banks, including foreign banks, had non-performing assets ratio comparable to public sector banks. Many banks, small and big, public, private and foreign, were in the same consortium, and thus attributing the problem to lack of skills only at public sector banks is an oversimplification of the problem. There was also some regulatory forbearance. Asset quality review introduced in 2015 tightened the situation and brought out greater transparency. It led to a doubling of the NPA ratio in 1 year. But By that time, damage had been done, and the banks were left with a huge problem with no immediate relief. The resolution process is taking time. Looking ahead, it is always possible to be wiser after the event. However, we need to study the past to draw appropriate lessons for the future.
For every stressed asset or NPA is lapses in the initial borrower due diligence. 54% attributed this to the inefficiencies in the post-disbursement monitoring process. 91% of the respondents said that an account should go through a forensic audit before it goes for restructuring. For the NPA issues is the stressed asset percentage, which has been a cause of concern in the last 2 years. While corporate borrowers continue to blame the declining economy, independent audits have identified two issues. It's either willful default or diversion of funds, which is added to the stress.
The lessons are there for the regulator, which is the RBI, the government and the banks. As far as the RBI is concerned, some of the lessons are, the regulator has the responsibility to monitor macroprudential indicators such as overall credit growth and also to spot excesses, if any, to certain sectors and groups. This has implications when the RBI tightens or loosens monetary policy. The RBI's concerns must be communicated to the government owners and made public. Regulation is no substitute for good governance. Regulatory design needs to reckon financial and business cycles and take remedial measures in time. This is not to deny the challenges faced by the RBI on account of external factors like the global financial crisis, 2008-09, and taper tantrum, 2013. Notwithstanding several measures taken by the RBI, including the 2016 guidelines, the performance of the resolution process has been slow and needs to be reviewed and remedial measures taken. The Insolvency and Bankruptcy Code, IBC, is an important innovation.
The problem is the banks didn't have enough power to get promoters to pay or to put the stressed assets back on track. They didn't have the right kinds of tools. And unlike a more developed country, we didn't have a functioning bankruptcy system. Now, bankruptcy systems work either by taking the borrower into bankruptcy or working as a threat by which the borrower agrees to out-of-court settlements, knowing that if that doesn't happen, the borrower gets dragged through the bankruptcy court. Now, without a bankruptcy court, neither was possible. What we've been doing over time is to give the banks the powers so that effectively they can carry out an out-of-court resolution with the borrower and put the stressed or stranded assets back on track. The prime
IBC is an important innovation, but glitches need to be ironed out. As international experience shows, increase in compliance cost does not automatically translate to better regulation. The regulatory regime needs to pinpoint parameters that need special attention. How to resolve the issue? The government certainly has the responsibility for overall management of the economy, and being the owner of the banks, it may push the banks in certain directions. This may have immediate benefits but may cause problems in the medium term. The government may ensure that banks are run in the larger national interest, but commercial decisions are best left to bank boards. Improvement in governance of the boards has been talked for long, but much needs to be done. The government and regulators need to promote specialized institutions for project finance. This is a throwback in time but is worth considering. The promotion of corporate debt markets both for performing loans as well as distressed loans needs special attention. Reliance on a project appraisal by just one single institution has entailed losses to a number of small and medium banks. These banks should not piggyback on project appraisal of other agencies. Banks boards must be empowered to decide on capital raising plans from the market within a well-defined framework. It is a well-accepted axiom that organizations raise capital when they don't need it immediately. Recapitalization may be done in cash rather than through bonds or in some combination. Banks need to take responsibility for the soundness of credit decisions. They need to define their own risk appetite rather than lean on the big lender's appraisal. Project appraisal and working capital assessment are quite distinct though related. Banks need to significantly upgrade their appraisal and monitoring skills and invest heavily in training. These cannot be sporadic and one-off but well planned for the long term. Risk management must improve at all levels. Assurance, systems, internal and external audits and credit rating need to be strengthened. Given the reported large-scale siphoning of funds, round-tripping of debt as equity through dozens of shell companies needs to be checked through forensic audits at annual reviews.
What is the solution? The solution is to create a Chinese wall that separates the politicians and the bureaucrats on the one hand and the banks on the other hand. And that is through the creation of a bank holding company. It is important here to create a bank holding company that is comprised of senior professionals from the banking sector, people of unimpeachable integrity and of incorruptible values, and of professional repute, so that they govern the banks in a commercial manner, in a manner that actually befits these commercial banks, so that they can compete well with the private sector banks, because the bottom line is that our government systematically undermines the very banks that it owns through these governance problems. So the key solution here is to actually bring them on an equal footing with the private sector banks by implementing these governance problems. Thank you.